Now, when we look at the equities market, it's very, very bearish. Information that investors are looking for, the performance of companies, how good they are in terms of going forward. Your views on a stock like PZ Cussons, where we've seen the earnings results seeming rather poor. Just give us a sense of why that is.
Well, they're quite weak, disappointing as well, but we think that there's a chance that the company could, sort of improve sort of the growth rate that they experienced in the first quarter through the full year financial 11. But I think that just looking at it on the surface, obviously, is not enough. Those numbers are not fully consolidated numbers, and they could obviously be slightly better on a consolidated basis. Key headwinds during the period were higher input costs, and there were also relatively higher branding and marketing expenses that the company basically looks to boost its branding out there, particularly given how competitive the environment is now.
Higher input costs are going to be compounded by a volatile Naira, as we've seen recently. We were hoping that we're going to see a Naira looking a lot stronger, but devaluation seems to be the order of the day. How does it impact a company like PZ?
Well, it will impact it significantly. We estimate that any sort of 1% decline in the devaluation in Naira could lead to anywhere between around 1 to 1.5% decline in the company's estimated earnings for financial year 12. The reason why it's that significant is because the company imports the bulk of its raw material across the board. So it's basically in two primary businesses. One is HPC, where it imports around about 72% of its raw materials. And then you've got another business in white goods where it imports almost about 80% of its raw materials. So it is quite a big risk for the company. The central bank has sort of moved positively with its policy response about 2 days ago, but I think that sort of currency devaluation risk is still there.
You talk about the white goods business. Tell us more what this is and how their profitability is failing to impact on the overall profitability of the company.
Well, the white goods business is basically just, they basically assemble refrigerators. They also do microwave ovens, stoves, TV, and other appliances. They're currently in partnership with Hair of China, so they currently produce all those equipment, so appliances, and also ACs as well. The company did suffer in the last down cycle. It lost volumes, and they also had to discount prices as well. We're starting to see a significant recovery in volumes and also margins in that business starting from the last quarter of 2011. So looking at the top line performance in the first quarter of financial year 12, we're continuing to see that trend, the uptick in the white goods business, and we think that this business could help support the full year earnings in financial year 12.
In order to cope with rising input costs that you refer to, it would just be logical to start raising their prices, but PZ has been a bit reluctant to do that. Why is that, and are we going to see changes in their pricing strategy going forward?
I mean, like I said earlier, it's a highly competitive market, especially in HPC. I do see the possibility of PZ raising prices, but this would be primarily in products where they lead in the market, so largely soap bars. But I think that in detergent, where they basically are second or third players, they're likely to follow their competitors like Unilever. I think that you're most likely to see a price increase during the periods where you see a stronger demand for their products. So we're talking about the dry season, right, anywhere between around about September to about March. Yeah. Okay,
the figures that we're seeing coming out of PZ, how do they compare to others in the fast-moving consumer goods sector, and in terms of how investors should evaluate stocks in this particular group?
I think PZ will definitely lag its peers in terms of performance. When I say peers, I'm just referring to the broader consumer universe. We're seeing strong growth in the beer segment, where volumes still remain quite robust. We're still seeing volume growth as well in the staple food segment, but sadly, you've also had some input cost headwinds there as well. But I think on average, the other consumer companies will do much better than PZ, because sadly PZ's raw material costs are somewhat skewed towards the performance of oil prices. And as you know, oil prices have remained relatively high since the start of the year, even despite, you know, the outlook for sort of a weaker global economy. I think oil prices have remained relatively firm since about June, July this year. So that is pretty much what's keeping PZ's raw material or input costs relatively high. I think that everyone seems to agree that oil prices will fall over the next 6 months. And I think that's why management is quite confident that they could see relatively flat to positive earnings growth for the financial year 12. We're just skeptical given some of the headwinds that it's faced in the first quarter, and also, you know, the potential of a currency devaluation.